Hey everyone, and welcome back to the Safe Simple Sound podcast. I'm Alex, and I'm thrilled you're here. At Safe Simple Sound, our mission is right there in our name. We want to guide you toward financial freedom using strategies that are safe, simple, and sound. Today, we are tackling a subject that often makes new solopreneurs break out in a cold sweat: accounting. But don't worry, we are going to simplify the complex. Our discussion today is based on a practical guide titled Master Single-Entry Bookkeeping, a simple system for solo entrepreneurs. This article is a goldmine for anyone looking to seize financial control without getting bogged down in complicated accounting rules. It's time to turn that shoebox of receipts into a system that actually works for you. Let's dive in. You might be thinking, Alex, I'm a graphic designer, or I fix cars, or I bake cookies. I am not an accountant. And here's the good news: you don't have to be. Today, we are breaking down the fear. We're going to talk about the antidote to that accounting anxiety, and it's called single-entry bookkeeping. So what is it? Let's strip away the jargon. Single-entry bookkeeping is basically DIY bookkeeping in its purest form. It is a practical cash-basis accounting system. That's a fancy way of saying we are only looking at when cash actually moves. We aren't worrying about complex accruals or money you might get in 3 months. We are focused on right here, right now. Think of it like your personal checkbook register. If anyone still uses the paper ones, you write a check, you record it, you make a deposit, you record it. That's it. One entry per transaction. The goal of this system isn't to create a complex financial model to show investors on Wall Street. The goal is simplicity and Schedule C preparation. It is specifically designed for bookkeeping for beginners, solopreneurs, freelancers, tradespeople. It's about answering 2 questions. Do I have money in the bank? And am I ready for the IRS? Here is the secret to making this work: the foundation. In a single entry system, your business checkbook is your source of truth. It is the heartbeat of your operation. This brings us to a really important concept. To make this work, you have to treat your business checkbook as a sacred space. That means, and this is the golden rule, you must separate your business finances from your personal ones immediately. Why is this cash flow management focus so practical for you? Because as a solo owner, you don't need to know your theoretical net worth on a Tuesday afternoon. You need to know if you can buy materials for the next job on Wednesday morning. When you view your business checkbook as the foundation, it changes how you handle daily transactions. You stop reaching for your personal debit card to buy printer paper. You stop using the business cash to buy your morning latte. The checkbook forces you to be disciplined because every single line item in there has to be about the business. It turns a mountain of confusion into a simple list: money in, money out. That is tracking business expenses without the headache. So I want you to reflect for a second. How are you doing this right now? Is it a shoebox full of receipts under the bed? Is it a mental note you hope you remember in April? Let's move past that. Let's get you on solid ground. Key takeaways. First, stop letting accounting intimidate you. Single entry is just tracking cash. Second, the goal is simplicity, keeping the IRS happy and your stress levels low. And third, your business checkbook is the anchor of the whole system. So, here's your homework for the week, and it's a non-negotiable step 1. If you haven't already, open a dedicated business checking account this week to establish the foundation of your single entry system. Even if you don't have an LLC yet, just open a separate account at your bank solely for business funds. Do it today. All right, so we've just established the foundation. You've got that business checking account open, and you're ready to treat your business like a separate entity, not just an extension of your personal wallet. That is a huge first step. But now we have to talk about the movement of that money, specifically the money coming in. We're going to master your daily and monthly cash receipts. I know. After a long day of working with clients, fixing cars, or shipping products, the last thing you want to do is math. But trust me, this part of small business bookkeeping is the difference between sleeping soundly at night and waking up in a cold sweat during tax season. We're going to keep this simple, practical, and effective. Let's start with the daily habit. Step 1 of single-entry bookkeeping is figuring out exactly what you made today. It sounds obvious, right? But if you're working with a cash register or a cash box, You need a system. Here's the formula. Total cash on hand minus your starting change fund equals your daily receipts. Think about it like this. You start the day with $50 in the drawer to make change. At 5 p.m., you count everything up and you have $300. You didn't make $300. You made $250. That $50 was yours to begin with. You need to record that $250 immediately. This is your daily summary of cash receipts. To make this stick, let's look at a real-world example. Let's talk about Henry. Henry owns an auto body shop. He's an expert at fixing fenders, but he's doing DIY bookkeeping to save money. It's January 3rd. Henry closes up shop and counts his drawer. After he subtracts his starting change fund, he's holding exactly $267.80. Now, Henry could just write down $267.80 in his notebook and go home. But Henry is smart. He knows that number is actually made up of two very different things: his actual sales and the sales tax he collected. This brings us to a critical rule of cash flow management. You must separate your sales tax from your net sales immediately. In Henry's case, looking at his receipts, that $267.80 breaks down into $263.60 for the actual car repair and $4.20 in sales tax. Why does this matter? Because that $4.20 isn't Henry's money. It belongs to the state. If Henry records the whole amount as revenue, he's inflating his income. He might spend that $4.20 thinking it's profit, only to be short on cash when the state comes knocking. By itemizing this daily, Henry ensures he never accidentally spends the government's money. So, Henry does this every single day. At the end of the month, he doesn't want to sift through 30 scraps of paper. He compiles these daily figures into a monthly summary of cash receipts. This is just a simple grid, one row for each day, columns for net sales, sales tax, and total daily receipts. When he totals up that monthly column, it should match his bank deposits exactly. This is the secret weapon for Schedule C preparation. When the end of the year hits, you aren't digging through a shoebox of faded receipts. You just grab your 12 monthly summaries, add them up, and you're done. You have total clarity. I want you to pause and reflect on your current process. When you make a sale, are you mentally separating the tax from the profit? What risks are you running by failing to separate that sales tax collected from your actual net sales revenue on a daily basis? If you're treating sales tax like bonus cash, you're setting yourself up for a painful surprise. And ask yourself, how much stress could you save if you traded that end-of-year shoebox nightmare for 5 minutes of organization each day? Here is your takeaway and your task for today. I want you to start this habit now. Action step: create a simple daily summary template. You can do this in a physical notebook or a Google Sheet. It needs 4 simple columns: 1 total cash on hand, 2 minus starting change, sales tax, net sales. Do this, and you will have mastered the inflow of your business. All right, so we've just wrapped up how to track the cash coming in, getting those daily receipts organized so you know exactly what your top-line revenue looks like. But as every solopreneur knows, it's not just about what you make, it's about what you keep. That brings us to the other side of the coin, and frankly, the part that keeps most of us awake at night: managing the outflow. Today, we're going to demystify a tool that sounds a lot more complicated than it actually is: the Disbursements Journal. Now, don't let the accounting jargon scare you off. Disbursement is just a fancy word for spending money. In the world of single-entry bookkeeping, this journal is simply your monthly expense summary. It is the tool for recording every single dollar that leaves your business checking account. Think of your business checking account as a busy train station. Passengers, your dollars, are leaving constantly. If you don't check their tickets, you have no idea where they're going. This journal is your ticket log. So how do we build one? Whether you are using a physical ledger from the office supply store or a simple Excel spreadsheet, the setup is the same. You need the basics to verify the transaction: the date, the payee who you paid, the check number, and the total amount. But here's where the magic happens, and where small business bookkeeping goes from data entry to business strategy. You need to set up specific columns for your expense categories. Let's go back to our friend Henry, the auto body shop owner we talked about earlier. Henry writes checks constantly. If he just listed everything in one long column, At the end of the month, he'd just have a big, scary number. Instead, Henry creates specific columns for his high frequency costs. Since he runs a shop, he has a column specifically for materials and another for rent. When he pays for auto parts, the amount goes into the materials column. When he pays the landlord, it goes under rent. For the random one-off costs, like that time he had to pay for a newspaper ad, he uses a general accounts column. This brings me to a question for you. Which 3 or 4 expense categories appear most frequently in your specific trade? If you're a freelance graphic designer, maybe it's software subscriptions. If you're a baker, it's ingredients. The strategy here is to give those frequent flyers their own VIP lane. It streamlines your data entry and lets you see at a glance exactly how much your core operations are costing you. Now, you might be asking, Alex, why can't I just look at my bank balance on my phone? Here's the reality check. Looking at your bank balance tells you what you have right now. Tracking business expenses in a journal tells you where your business is going. It provides a level of cash flow visibility that a banking app just can't match. You start to spot trends. You realize, wow, I spent 30% more on materials this month than last month. Why? And here is the biggest payoff, the future you benefit. This journal directly feeds into the annual summary you need for your Schedule C preparation. When tax season rolls around, you aren't digging through a shoebox of crumpled receipts or panic scrolling through 12 months of bank statements. You simply take the totals from your columns, materials, rent, advertising, and plug them right into the tax form. You are effectively doing your taxes a little bit every month, so April 15th becomes just another day on the calendar, not a crisis. So let's turn this into action. I want you to take a little time this week to get set up. Here is your challenge. Review your last 3 months of bank statements to identify your top recurring expense categories to include in your Disbursements Journal. Once you see where the money is really going, you regain control. All right, we've just wrapped up how to handle the money going out with your check Disbursements Journal. If you've been following along, you now have a handle on your daily cash coming in and your monthly expenses going out. You're already miles ahead of most people who just shove receipts into a glove compartment and hope for the best. But now we need to zoom out. We need to talk about the finish line of this whole process, the annual summary, and the big question every growing entrepreneur eventually asks, when do I need to get fancy with this? Let's start with the finish line. You've spent the year disciplined, tracking those monthly summaries we talked about. Now, it's time to bring it all home. Think of your annual summary as the season finale of your business year. It's actually incredibly simple. You take those 12 monthly sheets, one for your receipts, one for your disbursements, and you total them up. That's it. Why is this so powerful? Because when April rolls around and the tax man comes knocking, you aren't panicking. You're taking those final totals from your annual summary and plugging them directly into your Schedule C. You know exactly what your gross income was, and you know exactly what your deductible expenses were by category. You're not doing math on the floor of your living room. You're just reporting what you already know. That peace of mind? It's priceless. However, I want to be real with you for a second. Single-entry bookkeeping, this simple cash-based system we've been building, is fantastic, but it does have blind spots. It's like driving a car where the only gauge on the dashboard is the speedometer. It tells you how fast you're going. That's your cash flow. But it doesn't tell you how much gas is in the tank or the overall health of the engine. In accounting terms, single entry tracks movement, but it doesn't track assets like that expensive hydraulic lift Henry the auto body guy might buy. It doesn't track liabilities like a massive business loan, and it doesn't track equity, what the business is actually worth if you sold it today. This brings us to the big leagues. Double-entry bookkeeping. You've probably heard the term and shuddered, imagining guys in green visors shouting about debits and credits. But really, double entry is just a self-balancing system. Every transaction is recorded twice to balance the equation. The main output of a double-entry system isn't just a profit and loss statement, it's a balance sheet. So, here's the million-dollar question I want you to ask yourself right now. At what stage does your business need a balance sheet? If you are a freelance graphic designer or you're running a solo handyman service, your main concern is likely, did I make enough cash to pay my bills and buy materials? For you, single entry is king. Stick with it. But if you are incorporating your business, if you are bringing on investors who want to see the company's net worth, or if you are managing significant inventory, like a warehouse full of auto parts, that is when you graduate. You upgrade to double entry because you need to track the value of what you own and what you owe, not just what you spend. But hear me on this. Don't rush to upgrade just to feel professional. Mastering the simple system first puts you on a much more solid footing than trying to use complex software you don't understand. If you can't track cash flow in a notebook, a complex accounting software suite won't save you. It'll just confuse you. So, here are your takeaways for today. 1. Your monthly summaries add up to an annual summary, which makes filing your Schedule C a breeze. 2. Single entry is for tracking cash flow. Double entry is for tracking net worth, assets, and liabilities. 3. Don't complicate your life before you have to. I want you to take 5 minutes today to assess your current business complexity. Be honest with yourself. If you own significant assets, carry heavy inventory, or have investors, it's time to research double entry software or hire a pro. But if you are a solo operator, a freelancer, or a service provider keeping it lean, commit to mastering the single entry method first. Get that cash flow crystal clear before you try to build a balance sheet. And just like that, we've demystified the ledger. I hope you're walking away feeling a lot lighter than when you started listening. Today proved that small business bookkeeping doesn't have to be the stuff of nightmares. We learned that by embracing single-entry bookkeeping, you aren't cutting corners. You're actually building a rock-solid foundation for cash flow management. Whether you're running an auto shop like Henry or freelancing from your laptop, sticking to DIY bookkeeping saves you money and keeps you in the driver's seat. My favorite takeaway? It has to be the Disbursements Journal. It's such a simple tool, yet it completely transforms the end of the year. Instead of panicking in April, you're already set for your Schedule C preparation just by keeping those simple monthly columns updated. Remember, bookkeeping for beginners is less about math and more about the habit of tracking that money in and money out. And if this episode helped lower your blood pressure even a little bit, please leave us a review and share it with a fellow solopreneur who might still be drowning in a shoebox of receipts. Thank you for trusting me with your time today. Keep your systems effective, keep your mind clear, and as always, keep it safe, simple, and sound. This is Alex, signing off.